Welcome to the Allan Small Financial Show. I'd like to thank all of you for taking time out of your busy day to spend it with us. We continue to do these broadcasts so that we can help the average investor out there in Canada, in Toronto, and Ontario make sense out of these volatile markets. We come to you every other week, Wednesday at 12 noon, so we can make sense out of what's going on. I know a lot of you have a lot of questions. So if you do have questions regarding perhaps your portfolio or anything else to do with the stock market, please feel free to put them into the chat box through YouTube or Facebook Live. I'd be happy to answer your questions at the end of the show. We also, from time to time, have some fantastic guests. We've had Patty Levitt-Reed, Jonathan Chevreau, and today, Dan Kelly from CFIB, Canadian Federation of Independent Business. We'll chat with him shortly to see how small businesses are doing in Canada and what they're saying, what they need to continue to thrive and survive during difficult times. So without further ado, let's get on with the show. So as mentioned, today we have Dan Kelly from CFIB, CEO and President of CFIB, to talk about state of small business. We're going to go into our usual This Week episode or part of the show where we talk about what I believe is important for individual investors to consider over the next 5 to 10 business days. We're going to talk a bit about investor emotion. I've been talking to a lot of investors recently, and emotions are running extremely high, and how we cannot let those emotions get involved when we're making investment decisions. We're also going to talk about expectations. What should investors be expecting when they create a portfolio over the next 5 to 10 years of investment, or even longer? Should they expect the market to go up every year? Should they expect pullbacks every now and again? So we're going to talk a bit about expectations. And lastly, I'm going to take your questions on whatever it is you're wondering about, whether it's the market, your portfolio. I'll be able to answer hopefully as many questions as I can at the end of the show. Great. I'd like to welcome Dan Kelly, President, CEO, and Chair of the Canadian Federation of Independent Business, to our show. CFIB is the largest small business association in Canada with more than 95,000 members, advocating for small business with all levels of government, as well as providing advice, tools, and savings for its members. Dan has been with CFIB since 1994 and became president in 2012. In 2015, Power and Influence magazine named him as one of the top 100 most powerful and influential people in government and politics. Dan, welcome to the show.
Good to be with you.
Excellent. I thought we'd start off talking a bit about the state of small business. You know, obviously coming out of a pandemic, have these small businesses in Canada, and maybe more specifically in Ontario and Toronto, have they really come out of this pandemic fully, or are they still feeling the effects of what we just went through over the last few years?
You know, I'd love to sit and tell you that things are back to normal, but for so many small and medium-sized firms across the country, in our province, in our city, that's just not the case. At this stage, if you can believe it, fewer than 40% of small businesses feel that they have fully recovered from COVID and have sales back to normal levels. 60% of small firms do not have sales back to normal. And though many of those same firms, I think about 60% of them are carrying now COVID debt. On average, that's about $150,000 in fresh debt that they had to take on just to survive COVID. And then coming out of the pandemic, when we were supposed to be experiencing these boom times as we crawled out of our basements and then went and spent our brains out, that hasn't happened. In fact, with rising inflation, businesses are facing huge cost increases on every line of their budget. So it's a pretty awful scenario for so many businesses, especially as many are predicting that we're heading into a recession.
Yeah, those numbers are astounding. Is it more sector specific though? Like, are there industries obviously doing better than others? I would imagine perhaps maybe businesses in the travel industry might be faring a little bit better than some other businesses, or are you seeing this right across the board?
You know, the pressures are everywhere, particularly on the spending side of the equation because of the cost increases that businesses are facing. So even those businesses that have seen a more modest effect of COVID or have seen sales rebound, they're facing the cost increases and labor shortages that are causing them to have a long way back to profitability. But sectors like retail, hospitality, the service sector, arts and entertainment, travel and tourism, these sectors are way down, and you know they've got such a long road just to get sales back to normal, let alone try to deal with the costs that they've inherited over the course of the past couple of years.
Yeah, you know what? I get a chance to talk to a lot of small businesses. A lot of my clients are small business owners. And I guess what I've been hearing, I think it's changed a little bit over the last year. Coming into this year, I found they were saying a lot of the issues were around labor shortage, trying to get enough workers to fill the roles they had, especially in the restaurant area. Going to see some of my clients who own restaurants, they couldn't find people to wait on tables or work in the kitchen. Then that's, I guess, kind of mid-year that sort of changed a little bit. A lot of people now are talking more about inflation, higher interest rates. What do you think is, I guess, the main issue or the most, I guess, the issue you're hearing most when you talk to small businesses? What are they saying is affecting their business most? Is it inflation and interest? Is it labor, or is it something else?
Yeah, it's a combination of all of those things. But debt is a huge issue that businesses are facing right now. As I said, the average small firm has had to take on $150,000 in new debt on top of what they might have already had just to get past the last couple of years. That debt is now exposed to much higher rates of interest if it is in the form of any kind of lending instrument. Some of it, fortunately, is in an interest-free CEBA loan, the Canada Emergency Business Account loan, but those are coming due next year. So businesses are really struggling to figure out how they're going to find a pathway back to profitability. And that, you know, I mean, there are many that think that profit is a dirty word, but remember, these are families behind these businesses who rely on the income from the business in order to pay their own bills. And so we need to make sure that they are put back on a solid pathway. But when we see government right now making it worse rather than better, that really creates just a vicious cycle. And we see at the end of this year, we have Canada pension plan premiums going up significantly, EI rates going up significantly. Next spring, carbon taxes going up again, liquor taxes going up again. All of these are taking further bites out of household incomes, out of business incomes, and making a bad problem even worse. This is the time when we need governments to say, okay, we're going to take a break from those things. Sadly, they're doubling down and going ahead.
Yeah, and it's interesting. You bring up government, and what do you think government, Bank of Canada, can do to help these businesses? Obviously, during the pandemic, they had these programs that are no longer available that many businesses tapped into. What do you think government, what role can they play to help these businesses? I know the Bank of Canada has talked about bringing inflation down, how that is so important, how it's eating into people's paychecks, et cetera. My comment to the Bank of Canada would be, well, at least they have jobs and they have paychecks. If they continue to raise interest rates, businesses will be forced to lay off people, and inflation will be eating into their lines of credit or their credit cards. So what do you think, I guess, government can do at this point to help these businesses?
Step one is not making it worse. And sadly, that's what governments have been doing, is making it worse through the tax hikes that I just discussed a second ago. So if they laid off that, pause those things for at least the time being, that would be of significant help. Second, there is really a concerted effort needed to try to reduce some of the debt that businesses are facing. That could be a further forgiveness of some of the CEBA loans. That would take some of the debt off of the books of businesses, allowing more of them to survive what we expect to be some lean months in the days ahead. The other thing, of course, is that we're not asking for further subsidies or a renewal of the programs that were there during COVID, but for goodness sakes, governments could in fact try to address some of the skills and labor shortages that we're facing right now. That means further immigration, freeing up more temporary foreign workers to come to Canada. They have, to their credit, done a couple of steps, like making students eligible to foreign students eligible to work full time. That we think is good news. But a lot more is needed to try to supplement the Canadian labor force if we're going to have a hope of trying to capitalize on this. Look, right now we have businesses that are saying, okay, I think there's business enough for me to perhaps open a second location or reopen on Tuesday night, but I don't have the staff to do it, and therefore their business income is constricted as a result of that.
Yeah, for sure. I talk about supply side, right? Obviously, the inflation dynamic, demand chasing too little supply, and labor really is a crucial part of that. And that's why it baffles my mind how central banks, Federal Reserve in the US and Bank of Canada, continue to raise rates. They talk about how we need more supply, yet you continue to raise interest rates. I think that just takes away from the labor force, which you'll need to produce more supply.
Yeah.
And so I guess final question to you is, when you talk to all these businesses, are they talking about the big bad R word? Do businesses think we are already in a recession? Do they think we're headed for a recession? And what are they doing to prepare for perhaps a recession to come either at the end of this year or early 2023?
You know, for so many small businesses, they'd love to think about what the next couple of years are going to bring, about whether it's a recession or not. For most of them, as I said, only 40% of them are back to normal sales. It feels like a recession to them for right now. And it has felt that way for 2.5 years. Remember, in this city, we locked down tons of businesses and restaurants and restaurants and gyms, for example, for 430 days. So the damage that took place over that period of time has not been washed through yet. And we believe that there are about 160 to 180,000 businesses that we expect to fold as a result of the damage that they have taken on during the pandemic. So that has not gone through the system at all. We're starting to see small business bankruptcies tick up, but we believe we're at the tip of the iceberg. So for many, it feels for them like we're in recessionary times right now and have been for some time.
Well, hopefully something can be done either at the government level or perhaps the Bank of Canada starts to slow down this interest rate hike cycle sometime soon. Dan Kelly, President and CEO of CFIB, thank you so much for being with us this afternoon and giving us, I guess, the goods on state of small business in our country, our province, our city. Thank you so much for being with us.
Anytime.
Take care. Now's the part of the show where I talk about what I believe is important for individual investors to consider over the next few weeks when they make their investment decisions. We're going to talk a bit about economic data. We can't help but to focus on the latest economic data because we're all looking at crucial inflationary data. Some of it came out in the US this morning, PPI, Producer Price Index. Some of it will come out tomorrow, Consumer Price Index. Very important economic data. We're also going to look at corporate earnings. Corporate earnings, the kickoff to corporate earnings really starts this Friday when 4 major US banks will report their latest earnings. Lastly, the NASDAQ, lowest in 2 years. And we all know the NASDAQ for being the index that has primarily or mostly technology stocks, technology companies. And so why is that important? Let's touch a bit on that. So let's start on the economic data. As I said, Producer Price Index released this morning out of the US. And that gives us a good, I guess, insight into what we could see tomorrow when the Consumer Price Index is released, the data released. And what we're seeing today in the inflationary data that was released out of the US is inflation will probably be still stubbornly high in and around 8%. I don't think that's going to give the Federal Reserve any, I guess, impetus or any indication to lower or slow down the pace of interest rate increases. So I think come the beginning of November at their next meeting, you could possibly expect a 50 basis point or 75 basis point hike in their interest rates once again. It'll be another 75-point hike. I think that could be the third or maybe even the fourth that we've seen in a row, something we have not seen in quite some time. At least in my career, I have never seen hikes coming this quickly. The last time you had to see something like this was back in the 80s under Paul Volcker. But here we are going from basically a zero interest rate to one that is going to, looks like, end up somewhere around 4.5%. We're seeing the 2-year government bond rate in the US go from about 0.5% at the start of the year to well over 4% today. Huge increase, huge increase. So economic data will continue to play a part. We just saw some unemployment data out of the US and in Canada as well. Data that, again, should allow central banks, Bank of Canada, and the Fed to continue to raise interest rates. And we all know, and you can see on this chart, how much unemployment has come down. Everybody is out there that wants to get a job, can't find a job right now. We are seeing a bit of a pullback in job openings in the US, the lowest it's been in the last 14 months, but there's still a lot of job openings to be filled. So going forward, we need to keep an eye on the latest economic data. And for all of you that are watching right now, tomorrow will be a key indicator on how the market reacts and performs for not only tomorrow, but also for the rest of the week. The second topic, I guess, that I think individual investors need to keep an eye on is corporate earnings. And as I said earlier, we are heading into quarterly results or corporate earnings season. And you're looking at 4 major banks about to report earnings in the US, 4 largest banks or 4 of the largest banks in the US, JP Morgan, Wells Fargo, to name a couple. And what these banks, and you'll notice in this chart, a lot of their stock prices have come down substantially. JP Morgan, somewhere around $170 a share at its high point over the last year, now at $103, almost half its value eroded. Wells Fargo, when you look at how high they got, they hit about $60, so a third of their value gone. You can look at even names like Citigroup. Citigroup, we've seen also a third or as much as maybe 40% of their value has been taken off their market capitalization. So these banks have been hit quite hard. There's not a lot of positive expectations coming from this corporate earnings season in general. The bar has been set really low. So if corporate earnings come in, and I think if they are better than expected, we may see some upside surprises in their stock price, and we may see the market move higher because we've already built in such a negative quarter that any positivity may show a spark in their share prices. Lastly, but not least, the NASDAQ, another area to watch. The NASDAQ has hit the lowest point we've seen in the last few years. Certain parts of the NASDAQ or tech stocks, and you can see it right here, how low it's gotten, have sold off 50, 60%. If you look at some of the chip equipment makers, the guys who make the chips or the guys who make the equipment for the chip makers, like Lam Research. I think we have a chart on Lam Research. You'll see how much these stocks have fallen, 50, 60% from their 52-week highs. Unbelievable. Is it time to buy into these names? Well, I think it all comes down to time horizon. I think if you have a 2-3 year time horizon or even a 12-month time horizon, I believe these stocks will be higher 12, 24, 36 months from now. We know from past experience that when you do have a sell-off in certain areas of the market, that when things do get better, they get better very fast. In technology in particular, the NASDAQ, the chip makers, the FANG stocks, the Facebooks or the Metas, the Amazons, the Apples, I think these names could rebound very strongly. The question is, at what point do they do? And I think, unfortunately, we're going to have to see central banks slow down the interest rate hikes before we start to see some of these tech stocks really start to surge again. So those are the 3 areas that I think individual investors need to focus on before they make the decisions over the next couple of weeks. Investor emotions. a topic I wanted to talk about during this show. Again, speaking to a lot of my clients, speaking to a lot of investors in general, emotions are running really high. A lot of people are very concerned. They're seeing a lot of their profits over the last year or two being eroded, still up from the previous year. So they haven't lost all their profits from 2021. But as time seems to be moving on, more and more of last year's gains are basically being given back. They're concerned for their retirement. People that are in retirement are concerned for the money they have invested. And I understand that. However, what I want to say today to all of you that may be concerned and may be finding your emotions running away from you a little bit, please do not let those feelings of sadness or if you're nervousness, force you or cause you to make a wrong decision. I've had conversations with individual investors looking to perhaps sell their investments, move to cash. And I look at that and I say, well, when you think about how far we've come already, S&P 500 down about 25-26% from its all-time highs, NASDAQ down 35+% from its all-time high, Toronto Stock Exchange well into the double digits to the downside from its all-time highs. A lot of the losses I think we have already experienced. I know Jamie Dimon in a recent interview, Jamie Dimon, CEO of JP Morgan, and someone that is well respected in the industry, has said, well, maybe we could fall another 15-20%. But I think that was sort of an off-the-cuff remark. And, he was just stressing the fact that he sees that, a recession is very possible in the US. Well, I've said on our show and to many of you over the phone and by email communication that I think the US is already in a recession. And I think here in Canada, we are not in recession, but we could follow the US very shortly, perhaps beginning of next year. Obviously, a lot's going to depend on how the Fed reacts. And if they continue and Bank of Canada continue to raise rates as aggressively as they have, we could see a recession. But I think if we do, it will be mild. And for many of you, you may not even feel the effects of a mild recession. So I think you need to keep your emotions in check. This is where I think the help of an independent or an individual investment advisor, someone like myself, comes into play, because we can help you. We can help take that emotion out of your investing. We look at the numbers. We look at what your investment goals and objectives are, your time horizon, which I've said many times is key at this time, and we can advise you accordingly. I'll be honest, sometimes it's not what people want to hear. Sometimes I say things that, to them, it's like very difficult. Perhaps buying when those are selling, perhaps, taking some profit when someone might have a favorite name like an Apple and they may not want to take profit at this time. So these are the things an investment advisor should be doing, should be communicating. And lastly, they should be communicating their strategy. Having a strategy at this time is crucial and important to keep your emotions in check and to keep on the right track with your investing. So if any of you out there are feeling nervous, I understand, and you should be nervous. It's only natural or normal to be nervous, but you just don't want to make a mistake at this time, because making a mistake, getting out of this market too soon, or not taking a profit when you should, could lead to your returns being limited over the next 6 to 12 months. If you can make the right decisions based on the numbers, based on good quality, good ideas, and an effective strategy, I think this can help you get out of this funk, if you will, sooner and protect your investments while we're in these volatile times today. Lastly, I wanted to talk about what you should do when you look at your portfolio. Well, I think it's a matter of keeping it diversified. You want to have a diversified portfolio. Make sure you have different asset classes. Bonds are available right now. They're paying somewhere in the vicinity of 4.5%. Is it good for growth? Well, that's difficult when inflation is at 7%. Bonds are paying 4.5%, still down about 2.5%. But I think different asset classes can now play a bigger component or be a bigger part in a diversified portfolio. So I think you should start to consider fixed income as part of that safe component of your portfolio. So I thought we'd end the show off with some investor expectations. Again, talking to individual investors, and this is really who I'm addressing right now. I'm talking to the individual investor and what their expectations should be. When we look back in history, history gives us a great indication on how things will look in the future. Obviously, there are no guarantees, but we know that history is the best indicator for figuring out how things will look in the future. And when we go back in time, there have been many periods of time where we've seen sell-offs, as we're seeing now. 1999, 2000, as you can see on this chart, we saw a bit of a tech wreck, right? The tech bubble burst here in Canada. Nortel unfortunately disappeared, and many of the dot-com stocks that many people were investing in disappeared. And a lot of people had a difficult time in 1999, 2000. Going forward, we saw 2008, right? The financial crisis. We saw a decline in the S&P 500 or the markets in general, 50% in a 6-month period. For those of you that have been investing with me for many years, and there are many of you, we went through that, and there were difficult times, but we hung in there, and we used our strategy of upgrading the portfolio. And when things got better in the spring of 2009, I'll never forget it, March of 2009 was the bottom of the market. Markets just skyrocketed from there. Going forward, 2018, end of 2018, we saw, as you can see here, a big dip in the markets. And I compare 2018 to this year. I think that at the end of 2018, you saw the Federal Reserve, Jerome Powell, at that time, raising interest rates into a slowing economy, very similar to what he's doing now. The effects you saw in 2018 are similar to the effects you're seeing in 2022. 2020, we saw a huge decline in the markets due to COVID when everything was shut down. In the spring of 2020, March to be exact, we saw a 30 to 40% decline in the markets in March 2020, only to be followed by a tremendous rally in 2021. So here we are in 2022. I think if you look back in time, usually you're going to run into one of these difficult years every 5 years, probably get maybe 2, maybe 3 every 10 years. And this usually sets us up for the next bull market, for the next rally higher. We know that when you see a downturn like this, the market usually rallies strong, either the next year, perhaps the next few months coming out of it, and we rise back to the previous highs and then surpass those highs. The Dow Jones, remember, in the beginning 1980 was somewhere around 1,000 points. Today, even with the pullback in the Dow Jones, you're still looking at a Dow somewhere close to 30,000 points. So in the last 40 years, the market has gone up significantly, and the market will continue to go up significantly, but you just have to keep in mind time horizon. If you have time to be in this market, now could be a fantastic entry point for the next 2-3 years to come or longer. If you need your money in the next couple of months, well, obviously that's a different conversation we need to have. So having the right expectations, understanding that these difficult times do happen, is very important, especially if you're going to invest in the stock market going forward. So now's a great, in my opinion, the best part of the show. I get to answer your questions, viewer questions. If you have any questions, please put them in the chat box. I'd love to answer them for you today. And if you have a question when you're watching the show, I guess maybe later on again, if you have a question, send me a message, an email. If you have a question regarding any future shows, any topics you want to hear, please send me those as well. I'd love to speak about what's on your mind, because that's what this show is all about. So I think we have enough time to answer just a few questions here. The end of year is fast approaching. Is there anything I need to do or to be doing with my investments to prepare for tax season? A good question. And usually I get into this whole idea of perhaps tax loss selling. If someone has a capital gains, an outstanding capital gain, I know maybe this year it's tough, or maybe not. Maybe some do have capital gains. You may want to offset it and sell something that has a loss to offset those gains. So bring down your capital gains that you're going to have to pay tax on. I know at the end of the year, a lot of people focus on their RESPs, not to do with taxes, but their RESPs. RESPs are calendar based on your calendar year. So you want to get those RESP contributions. Our RSPs, you have the advantage of investing for the first 2 months of the new year and still get a tax deduction for 2022. So the deadline will be roughly March 1st, 2023 to get a tax deduction. But I think overall, I think it's a great time to look at your portfolio as we approach year end and figure out if there are any changes that need to be made in general. As you all know, I'm constantly looking for changes to people's portfolios to better them, to increase the quality or better the quality of portfolios. And that's what I do every day here. So as we approach year end, there are a few things you can and should be doing. Perhaps even a call to your accountant may make a big difference before you make any investment decisions. Another question here. I keep hearing that there are good buying opportunities right now, but if I need to sell some of my stocks to buy the sales, is it worth it? How do you figure this out for your clients? So I guess the question is, how do you know when to sell? And I think that's an amazing question, because a lot of my clients or investors that I may recommend a sell to, they're thinking, but I'm down today. I'd just be realizing that loss. What if we hold it? It'll come back. And that may be the case. But I think when I do recommend a sell, specifically myself, or when you're looking to sell, I think it has to be for a reason. Perhaps that company or that investment is no longer as good as it once was. Perhaps some new information has come out, and owning those shares, if it's a stock, is not the right thing to do. Perhaps selling that name today to buy something of better quality is now available, so that what you're buying will either move up quicker or perhaps provide more protection if we think the market still has more room to fall. Perhaps you're selling to maybe lower the risk of your portfolio. Maybe you're at a stage in life or your investment objectives have changed where you need to now lower the risk of the portfolio. So there are a lot of reasons to sell an investment, of which none of them, as you may have noticed, is, well, it's fallen, so I'm going to sell it. I think you want to continue to look at the quality of the investment before you make any sells or any buys for that matter. Perhaps that stock has fallen, but it still is good quality, and maybe that's an opportunity to buy more. So anytime you look to sell something, it has to be for a reason, and not necessarily because it's down 15% or 20%. That might be another buying opportunity or an opportunity to buy more of that stock. So with that, I'd like to say thank you to all of you that have tuned in to this week's show. As you know, we'll be back on air 2 weeks from today. So I believe that is the 26th, if I'm not mistaken. And I look forward to seeing all of you again, 12 noon on the 26th, which is a Wednesday. And until then, happy investing.